Welcome to the Explainer. Today, we're getting into some really powerful stuff from trading champ Mark Minervini. We're going to break down the actual math. The math that separates the pros from the gamblers.
So let's just start with a super simple bet. Imagine we're flipping a coin. If it's heads, you win $2. If it's tails, you lose 1. Now, even if it's a 50-50 shot, you are going to take that bet all day, every day, right? Of course you would, because the math is just so clearly on your side. And believe it or not, that simple little idea, it holds a huge secret to successful trading.
And here it is. The whole secret boils down to one core principle. Never, ever risk more than you realistically expect to gain. This is it. This is the foundation that changes trading from just rolling the dice into a real, calculated profession. Now, it sounds almost too simple, doesn't it? But as you're about to see, most people get this completely wrong.
All right, so let's start by busting the first big myth that just traps so many traders. It's this belief, this feeling, that you have to be right most of the time to make any real money. I mean, it makes sense on the surface, but the math tells a totally different story.
In the trading world, we call your win rate a batting average, or sometimes you'll see PWT, percentage of winning trades. It's really just what percentage of the time do you pick a stock that actually goes up and you make a profit on it? Simple as that.
Now, think about this for a second. Ted Williams. I mean, we're talking about a legend, a total master of his craft. And yet, he failed to get a hit almost 70% of the time. That tells you something huge. The goal isn't to be perfect. It's not even about being right more often than you're wrong. It's about making your wins count and making sure your failures don't count for much at all.
And that leads to this crucial point. The best systems are built by planning for failure. See, you can't actually control what a stock does after you buy it. That's totally out of your hands. But you know what you do have absolute 100% control over? How much you're willing to lose. By just keeping those losses small, you can have a batting average well below 50% and still be wildly profitable. Okay, let's jump to the next myth, because this one illustrates some really dangerous math that catches almost everyone. A lot of people think that if a stock is more volatile, it bounces around a lot, you should give it more room to fall. You set a wider stop loss, your exit point. It kind of sounds logical, but I promise you, it is a mathematical trap. So let me ask you this. Let's say you're keeping your reward-to-risk ratio at a really healthy 2-to-1. Which system do you think makes more money? A system with these small, consistent 4% gains? Or a system with massive, home run 42% gains? Now, the answer here is completely counterintuitive, and I'm telling you, it will probably change how you look at risk forever.
So first up, let's look at the exciting strategy, right? The big win strategy. We're right 40% of the time, and when we're hitting these massive 42% gains. Now, to keep that 2-to-1 ratio, we have to accept some pretty big losses too, 21% on average. This feels like it should work, right? Those huge wins have to cover the losses. But they don't. After just 10 trades, this system, it's actually lost money. You have less cash in your account than when you started. How's that even possible? Now, let's look at the second system, the much less exciting one. Same 40% batting average, but here we're just getting tiny little 4% gains, and we're taking even tinier 2% losses. We're still keeping that exact same 2-to-1 reward-to-risk ratio. And boom! This is the secret. This boring system, it actually makes a consistent profit. You end up with more money. The system where the gains are 10 times smaller is way more profitable, simply because it avoids the devastating power of big losses. So why? Why does this happen? Well, it's because of a brutal, unforgiving mathematical reality. A 10% loss needs an 11% gain just to get back to even. A 20% loss, now you need a 25% gain. But here's the killer. A 50% loss requires a massive 100% gain just to get back to where you started. Big losses don't just subtract from your account, they geometrically cripple your ability to grow your money. And that's why keeping losses small is everything.
So, okay, if a high win rate isn't the secret, and if chasing those huge flashy gains can actually be really dangerous, what is the solution? What's the actual formula for consistent long-term success in the market?
It all comes down to this one number, expectancy. This formula right here, it weighs all your wins against all your losses, and it tells you, on average, how much you can expect to make for every single dollar you put at risk. If that final number is greater than 1, you have a positive expectancy. You have statistical edge. This is the only holy grail in trading, period.
Now, that formula is incredibly powerful, but it has one big catch. It's only as good as the numbers you plug into it. And this right here is where most people make their single biggest mistake. They feed the formula with hope instead of reality. This shows you the critical difference. A theoretical-based approach is when you say, I think this stock could go up 30%, so I'll risk 10%. See? You're basing your risk on a guess, a hope. The professional approach is result-based. You look at your actual trading records and you say, okay, my data shows my average winning trade has been 12%. Therefore, to keep a positive expectancy, I simply cannot risk more than 6% on any trade. You align your risk with your proven, real-world ability, not your imagination.
And this reality-based approach has to be dynamic. When the market gets choppy and your results start to slip, your batting average drops, your average game gets smaller, you have to adjust. You tighten everything up. You cut your losses even faster, you take smaller profits off the table, you get off margin, and you trade with smaller position sizes. You play defense by adjusting your risk to match the new, tougher reality.
Ultimately, all of this math, all of these rules, it's really about shifting your mindset to think like a professional. It's about leaving the amateur's game of hope and certainty and entering the pro's game of probabilities. Think about a professional poker player. They get dealt a pair of aces. They know it's an 80% hand to win before the flop. Now, do they know for sure if they'll win this specific hand? Of course not. An opponent could hit a lucky card. But they know that if they just play that hand aggressively, time and time again, over the long run, they are going to come out way, way ahead. They don't need certainty, they just play the probabilities.
And this really is the final, most important takeaway. Learning how to lose correctly, and by that I mean small, controlled, unemotional losses, is the only real path to a fortune. You have to embrace those small losses. Think of them as a simple business expense. They're just the cost of doing business that protects your capital for the big, compounding wins that your system will eventually deliver.
So I'll just leave you with this one question to really think about. Look at your last few winning trades. Were they the result of a disciplined process, or did you just get lucky? Did you risk, say, 15% to make 10%, but it just happened to work out? Because winning incorrectly is so much more dangerous than losing correctly. It teaches you all the wrong habits that will, eventually and mathematically, lead you straight to ruin.